Hey everyone, and welcome to this week's On the Spot. I'm Director of Freight Market Intelligence, Zach Strickland, here with, as usual, John Paul Hampstead, our Director of Passport Research. And we're here to talk about what's happening in the market, the freight market today, give you guys a little insight on what to expect moving forward. But so far, JP, we've had another record week for our volume expansion. Tender rejection rates continue to climb. We just surpassed, we're the all-time high for the, well, I should say the annual high for the year, just surpassing 19.39% on the outbound tender rejection index. Tender volumes again keep going up higher and higher.
Right.
You know, where does it stop?
Well, yeah, and tenders going up makes a lot of sense. To me, where does it stop? You know, I don't know. I mean, the expanded unemployment benefits in this weekend, Congress still seems really far apart on a new stimulus bill. Part of that has to do with how much more enhanced unemployment benefits there will be. Part of it has to do with liability for employers who are bringing people back to work. But you know, that's always something that people bring up, but they never have an answer as to like how that will actually affect.
Yeah.
Like, will it force people back to work? Will it cause consumer demand to crash again? Both.
Yeah, I mean, to me, I have a sense in the long term, we haven't solved all of the issues moving forward. I mean, unemployment levels are still high, but again, stimulus packages and things like that have kind of propped that up. You know, so that's explainable in the near term. Eventually, we'll have to continue to find a solution for that, as you know, some of these businesses haven't come all the way back into the full swing of things. But that being said, the freight market has been astoundingly resilient and very disconnected from a lot of the macroeconomic figures that we've looked at, especially on the industrial side.
Although that's coming back now too.
Yeah. Which could
quite
be
strongly
here in the next few months that the freight market could have just an extended run of what it's having.
I think that's true. I think that service consumer spending, like on travel, airlines, hospitality, even restaurants and sports events, is likely to stay depressed for longer. So tangible goods benefit from that. Obviously, you know,
but those are services. Those are a lot of services, not a direct connection.
That's what I'm saying. Yeah. That will stay depressed, meaning that people will spend their money on tangible goods.
There you go.
Is what I'm saying. Okay. Which is what's happened so far. So I think that sort of mix shift tailwind will continue for freight. I think as more people go back to work, as the economy produces more. Even I was talking to people who in Texas have said that oil and gas is actually coming back much stronger than most people realize. The recovery in oil production in shale has already started again.
Right.
So, you know, I think that there's a lot of alternative data about industrial production that needs to be digested by markets, really, and economists. You know, like I think people freaked out yesterday about the Q2 GDP print, but it's like we're literally at the end of July already.
We've already finished it. It's gone.
Right. It's an average of a quarter that looked like this, right? And so it's like that was back. So we're talking about like
like we talked about last week, a single data point to represent an extremely volatile. You know, it's that average of 0 to 100, whereas we're used to being like 40 to 60.
Right, and so we're talking about like the GDP print was probably like what mid-May was sort of like, and now we're at the end of July.
But again, Anthony Smith just yesterday was talking about how you have to really be careful with that GDP number in regards to freight, because there's two parts of it. There's services, which is 70% of that number, and then the durable goods side, which is 30% of that number, roughly.
Yep. But we think that, I mean, it's clear to us the way that relative capacity has continued to tighten, or the way that OTR has continued sort of taking legs up incrementally over time, that it's not just the sudden sort of COVID volatility spikes. That really what we think has happened is that the mix shift into freight has touched off another tightening truckload capacity cycle that is here to stay. I mean, we talked to some, a great industry expert earlier this week who said that his view was that truckload capacity is pretty much sold out for this year. He was like, I think what we have now is what we're going to have through the end of the year.
Basically, there's not going to be people returning to the market because we had this huge shedding in 2019 of a lot of capacity. You know, I think you said 1,000 trucks a week almost.
Yeah.
And then 2020 with COVID, you have another, like, you know, you have all these, you know, unemployment benefits and stuff that's probably, you know, you had a lot of people come off the road that still haven't returned yet. And that's also, you know, kind of a limiting factor in terms of getting people back into the truck.
So, you know, before the July 4th holiday, we were saying, like, what will July look like after the holiday? Now we know what it looks like. Rates stayed strong, capacity got even tighter, volumes held up, most importantly. And I think this just sets us up for a volatile, you know, Q3, Q4. I don't think there's anyone who, you know, believes that things will be relatively normal and calm going forward.
No. Yeah, Vincent and I were talking about it on freight forecasting one day, how, you know, we had this temporary return to seasonality in June. Looked like things were going to kind of progress back into the pattern of before, and now it's completely haywire. Like after mid-June, we saw things go pretty much off the rails. You can't really apply any true seasonality to anything moving forward at this point. The maritime side of things
it's heating up.
Is still very strong. It's stronger, getting stronger. We do have a few things down the road that look like may present an issue, but I was talking to Henry Byers about some of those blank sailings that we're seeing in October, September. He said those are not something to make any huge deal about just yet. A lot of people will cancel those way ahead of time just because they're not sure of what's going to happen.
Yeah, and I saw some of them just get reinstated as going to happen this morning. So, yeah, no, I think when you listen to the earnings calls, and you especially, you know, the CEOs of truckload carriers have been very, I would say they've been cagey about guidance, but cagey implies that they know something that they're hiding. Yeah, maybe they don't know, right?
They want to produce guidance that says this bull run is going to extend throughout the next 2 quarters, because then they set themselves up for the opposite effect of what they just did in the second quarter.
So Eric Fuller was very aggressive and bullish. He said that he expected a strong trucking market for the next 4 to 6 quarters.
Right.
Derek Leathers was also really constructive. He kind of approached the question differently. He didn't come out and say, like, yeah, like our revenue's going to keep growing like the next 6 quarters. But what he said was he talked about capacity, and he talked about the structural constraints on capacity. And one of the things that he mentioned that I thought was pretty interesting, it wasn't about like bankruptcies and things like that. He said that if you look at the training school data or the driver school data, there are 100,000 fewer new drivers than there should be than in a normal year because of you know, I guess closures and things like that. So that's a number he's looking at that'll keep a lot of fleets from growing, especially enterprise carriers and people like Werner. But you know, that obviously has a trickle down effect, and it applies certain things for attrition in the industry. So he thinks that he compared it to missing sleep. He's like, you can't make it up, and it will continue to sort of ripple through the industry going forward.
So I mean, effectively, we're talking about, you know, fleet growth, people returning to the market, generating capacity, and it's just basically saying that's not going to happen. Just like, you know, 2018. We saw a bunch of people re-enter the market, jump into their trucks and get going. Owner-operators came from larger fleets. You know, larger fleet drivers went to smaller fleets. It's kind of a trickle-down effect in the market. But what you're stating is we're probably not going to see that same level of re-entry, that same level of, you know, people kind of bouncing down the ladder this year.
Correct.
Yeah, I think it's interesting to look at some of those seated truck counts in those earnings calls too. It was kind of mixed. In the way that people grew or retracted in their fleet counts or their truck counts. we didn't see, it was kind of big to both ends. Some people decided to go all in the last year, and some people decided to pull back.
And some people had parked tractors that they were able to reseat, it seems like, right?
Yeah, and we're going into, the third quarter, approaching a bid season. A lot of these contracts get implemented in January. This is going to be one of the most interesting bid seasons, I think, on record.
Yeah,
it's going to be hard to, I think, for a lot of brokers out there to manage through some of this.
Yeah, and that we just released some research that looks at how the COVID volatility and the subsequent tightening of the trucking market has impacted kind of different modes. And so we looked at earnings, we looked at UPS earnings, we looked at Werner, US Express, C.H. Robinson.
Right.
And it's kind of interesting because the parcel carriers saw the impact first as tons of consumer spending migrated online. So their normal mix of business to consumer deliveries and business to business deliveries was really thrown off and biased toward B2C.
Right.
Which,
sense.
They saw a huge revenue lift, right? They saw a lot of margin compression. B2C delivery densities are very low. Revenue per parcel in domestic package has been going down for a long time. And there's a lot. We actually wrote some research about this. But now they're seeing that balance, that revenue mix normalizing again. So B2B is growing and B2C is coming off the highs in terms of mix. So they're kind of getting through the COVID hump in a way. And truckload carriers are sort of just now entering it, or entered it sort of in March, or in June rather. July is looking better. Hopefully that continues. They're actually seeing like volume and revenue, positive incremental moves. The brokerages, in my view, have not mostly seen a benefit from either the COVID volatility or this sort of inflection point in the truckload market.
And to that point, normally the brokers, they entered these contracts, they don't control the assets. So when they enter these contracts at a low cycle and then all of a sudden it goes to a high cycle, they lose a lot of control, and now they have service deterioration, et cetera. They can't control their margins as effectively, especially when you're talking about significant increases year over year. And we're talking about significant increases 3 months ago, from 3 months ago. Yeah. So that I think this year we're going to see.
That gets back to your point about contract rate negotiations, right? I think in the last upcycle that began in 2017, there were talking points like the ELD mandate that created a perception of a permanent constraint on capacity that would justify taking rates higher for another 12 months. Yeah. Right now, does anyone believe that the sort of confusion and the messiness and the imbalance of COVID-related demand surges justify like a 12-month increase in contract prices? I don't know. I guess it probably depends on what vertical you're in. Probably depends on, if you're a shipper, to what extent you've been able to buy capacity that actually shows up for you.
Right.
But I just think that the sort of uncertainty and unpredictability of the market right now is weakening the 3PL's negotiating leverage, when it comes to contract rates.
Yeah, because they, just by experience, by nature, they're going to have to get some form of rate increase out of this because they cannot sit on the floor. They'll lose capacity. They won't control it as effectively if they do that. So I think that's going to have upward rate pressure, especially on the contract side this year. Anybody that uses some form of managed transportation is probably going to see that. Again, not even if volumes do kind of come back down, but we're all prisoners of the moment to some extent in the pricing world. I do think that we will still see some sort of upward pressure because volatility is.
Yeah, when Bob Biesterfeld is talking about C.H. Robinson's managed trans business seeing only 70% first tender acceptance rates, I mean, that's even higher than OTRI.
Yeah. In
terms of rejections, right? So that's managed trans.
That's exactly right.
That causes problems. Yeah. That causes big issues.
Because a lot of what OTRI does is shipper to carrier, not shipper to managed trans.
Right.
So, well, we only have a few seconds left. I mean, we still had a lot to talk about, but you know, stay tuned every week to watch On the Spot as me and JP try to break down the craziness that is this freight market. And of course, as always, check out FreightWaves.com for any future freight market insights. Have a great week.